The stock market sounds complicated, but it's actually simple. Think of it as a busy marketplace where people buy and sell pieces of companies every day. A stock is just a small slice of ownership in a business. When you buy a stock, you literally own part of that company. Prices change daily as buyers and sellers agree on what those pieces are worth. Over long periods of time, the U.S. market has tended to rise, even after crashes. That's because long-term investing benefits from compounding. Gains create more gains. Patience beats timing. Time in the market usually beats trying to time the market. The first step is simple. Open a brokerage account to buy stocks and ETFs online. Most brokers today offer low or no minimums, with quick and easy signups. Learn the basics. Stocks mean ownership. ETFs are baskets that hold many stocks together. ETFs give you instant diversification across hundreds of companies. Dividends are portions of profit that some companies pay to shareholders. Diversification reduces risk. Never put all your money into one stock. Many beginners start with low-cost index funds, like the S&P 500. Index funds track the overall market and keep fees low. Invest regularly using dollar-cost averaging to smooth out market swings. Set clear goals. Keep position sizes you can sleep with, and avoid leverage. Use logical stop losses and keep an emergency cash buffer outside investments. Protect your accounts and secure long-term holdings properly. Keep learning from trusted sources like investor.gov and Investopedia. Avoid panic selling during dips. Stick to your long-term plan. Start small, be consistent. Let time and compounding do the heavy lifting, because small, disciplined steps taken over years are how most investors quietly build wealth.